Look, we all want our money to grow, right? But the second you step into the world of investing, you're faced with this fundamental trade-off. The chance to make money always comes with the risk of losing it. So today, we're going to break down what those risks really are so you can go in with your eyes wide open.
Okay, so let me just ask you something. When you hear the words investment risk, what's the very first thing that pops into your head? For most of us, if you really think about it, it all boils down to one simple, really powerful idea.
And yeah, that idea is simply losing your money. It's the risk of losing the capital you've worked so hard for. Now, it's not a risk to your life or your health, but let's be honest, it can feel absolutely gut-wrenching. The thought of watching your savings shrink instead of grow, that's a serious, serious concern. And it's really the core risk we need to get our heads around.
But here's the thing. Risk isn't some universal, one-size-fits-all deal. How we feel about the possibility of loss is deeply personal. So if you want to invest smartly, you've got to start by understanding your own personal relationship with risk.
You know, when you boil it all down, investors pretty much fall into two main camps. On one side, you've got the risk haters. For them, job number one is just don't lose money. On the other side, you've got the risk lovers. Now, they're not reckless, but they're willing to accept the possibility of a loss because they're focused on that potential for a much bigger gain. And look, neither one is right or wrong. They're just different ways of being wired.
All right, let's try a little thought experiment to make this super clear. Imagine I offer you a simple 50-50 bet. You give me 10,000, we flip a coin. Heads, you get 15,000 back. Tails, you only get 5,000 back. So, a 50% shot at making 5 grand and a 50% shot at losing 5 grand. So, what does your gut tell you? Would you take that bet?
Now, if your immediate reaction was something like, no way, I'm not doing that, then you're probably what we'd call a risk hater. For a lot of people, the pain of losing that 5,000 would feel way, way worse than the joy of gaining 5,000. But if you thought, sure, I'll take those odds, you probably lean more towards being a risk lover. Knowing which camp you fall into is absolutely crucial for building an investment strategy that you can actually stick with.
And this, right here, is what they call the sleep test. It's a classic. The story goes, there's this Wall Street trader who bought a ton of shares in something, and he was so anxious about it, he just could not sleep at night. He goes to this old veteran trader for advice, and the old-timer tells him, it's simple. Start selling, keep selling off a little bit at a time until you reach the point where you can sleep. See, the amount of money you can have invested and still sleep soundly, that's the right amount of risk for you.
Okay, but here's something really important that a lot of people miss. The day-to-day ups and downs of the market, that's not the only risk you face. There are other dangers out there that have absolutely nothing to do with whether a stock goes up or down.
So first up, you've got something called custody risk. I mean, think about it. Where is your money actually being held? Is it with a huge, regulated bank or with some brand new company you've never heard of? You have to trust the institution itself. And then there's manager risk. If you're not picking the stocks yourself, who is? This is the risk that the person managing your money is either just bad at their job or, even worse, dishonest. Trust me, both of these are just as real as a market crash.
Okay, so we've got all these different kinds of risks. Market risk, custody risk, manager risk. So how in the world do successful investors deal with it all? Well, it turns out there's one core principle that stands head and shoulders above everything else as the best defense.
You know, to really get the solution, let's first look at the problem in its most extreme form, putting all your faith into just one single investment. Let's take a real-world example, the company Teva Pharmaceuticals. For years and years, this company was seen as an Israeli corporate titan. I mean, this was a blue chip, a rock-solid stock.
So imagine you put all your savings into Teva stock just a year ago, thinking, hey, this is a safe bet. Well, you would have lost half of it. 50%. Just gone. This one example proves that no matter how amazing a company seems, betting your entire future on one single horse is an incredibly dangerous game.
And that terrifying example brings us to what is maybe the single most important principle in all of investing: diversification. You've all heard the saying, don't put all your eggs in one basket. Well, in the world of investing, that is the golden rule. It just means spreading your money across many, many different investments so that if any single one of them fails, it won't completely wipe you out. So let's be super clear about this. The wrong way, the risky way, is to just pick one or two stocks you've heard of, like Teva or Amazon, and just cross your fingers. The right way, the way you actually manage risk, is by building what we call a basket, a portfolio that holds a whole bunch of different stocks, bonds, and other things.
Which of course leads to the obvious next question, right? How is a normal person, someone with a day job, supposed to build and manage a basket with, I don't know, dozens, maybe even hundreds of different investments? I mean, it sounds like a full-time job.
Well, it turns out that exact problem is why mutual funds were invented, and that's exactly what we're going to dive into next.